Hello, everyone. Thank you for joining in on my webinar of how to become your own bank. My name is Lisa Campusano, and I'm a financial literacy specialist and founder of the Legacy Creators, a leadership development company that focuses on breaking generational curses through financial literacy. Now, I know if you're watching this, you must be very curious onto how you can become your own bank. But before I start off, I want to cover three main concepts, okay? Number one being inflation, number two being taxes, and three, compound interest. So before I get into those, I want you all to understand what is a bank, right? Because if we're looking to become a bank, then we need to understand how banks work. So understanding that, it means you understanding that a bank is a financial institution where people can save and borrow money, right? Now, the average interest rate that the bank gives you in a savings is about 0.04%, which is less than 1%. But on top of that, we have inflation. So this is where inflation comes in. Now, inflation is the cost of living increasing every single year. And at the same time, the power of the dollar is losing its value. So this happens at an average of 3% every year. So for example, let's say you have $100 today. That $100 next year is going to be worth $96, okay? And then so on and so forth is going to be every single year after that, it will be losing an additional 3%, okay? So on top of inflation, we also have taxes, okay, which we all have to pay. But I want you to understand, right, taxes also have to do with your tax bracket. If you don't know where your tax bracket is, you can Google it, okay, speak to your tax specialist, accountant. So once you pay taxes, what are our real numbers, okay? After incorporating inflation and taxes, what are we getting in return, okay? So I want us to take a look at this example right here. And this is just, a quick example that I'm getting from our Saving Your Future book, our Finance 101 book. If you're looking to, interested in reading it, I'll put the link in the email that I'll send after this. Okay, so here's the real rate of return. Let's take a look at the first example. Assuming you save $100 and wherever you're saving it, you're getting a 3% rate of return, okay? After you pay taxes, you're left with $102.25. But here comes inflation, and in this example, inflation is at a 3.5%. So minus inflation, you're actually left with $98.75. So in this scenario, you lose. You started off with 100, but after including inflation and taxes, you're left with $98.75. So this is how your money is losing its value. Now, in example number two, you save that same $100, but now you're getting a 5% interest rate or rate of return. And then, of course, you pay your taxes. After taxes, you're left with $103.75. After inflation, you're left with $100.25. Okay, so in this example, you earn 25 cents. So what I'm trying to get at is that in order for you, okay, to beat taxes and inflation, you should be at least getting a 5% or more in interest. Okay, so I want you to ask yourself, are you currently earning a 5% interest rate or more where you're currently saving your money? Okay, and is that consistent? Right? Because in most situations, the answer to that is no. So this is what we need to do about this, right? How is it that we're going to position ourselves to beat taxes and inflation? So the answer to that is to compound interest. What is compound interest? Compound interest is interest gaining interest on top of interest on top of interest. Okay, so it's in essence your money making money. Okay, so to dive a little bit more into that, I want us to touch into a very, very important discovery in finance, which is the rule of 72. Okay, the rule of 72 helps you determine how long it takes for your money to double depending on the account that you have it in. All right, so listen to this. We're going to take the number 72 and we're going to divide that by any rate of return. All right, so for this example, let's use the bank. All right, now I'm going to be generous and I'm going to say that the bank is giving us 1%. So I'm going to take the number 72, divide that by 1%. And what would I get? 72 years. So that means that if I were to leave my money in the bank, earning a 1%, which I'm not, it will take 72 years for my money to double, right? That's insane, 72 years. I don't know about you, but I definitely don't have 72 years laying around for me to just wait for my money to double, okay? So that right there is the combination of saving and losing money at the same time. That's not something you wanna do, okay? But of course, if you don't know any better, you can't do any better. So now that you understand these three key things, finally, how do I become my own bank? Okay, so in order for you to understand how you can become your own bank, I covered the three main things, but now I want you to understand, where do banks actually put their money? Okay, because the money that you're putting in the bank, not every single dollar is staying at the bank. Okay, let's say, for example, you put $1,000 in the bank. $100 remains in the bank, but the other $900, what will they do? They will invest it and they'll lend it out, okay? Now, you don't see this happening because if you go to your bank account, you will always see that $1,000 there, but it's called leveraging. So they're putting that money to work for them. So where do they put their money? Well, in the market, stocks, mutual funds, bonds, and, okay, listen to this one, cash value life insurance, okay? Yes, you heard that right. Cash value life insurance is actually one of the places where banks invest a lot of money. And I'm talking about billions of dollars, okay? They invest billions into these cash value life insurance. Now, okay, I know you would probably think that that's a oxymoron, because when you think about life insurance, you think about death, right? You don't think about building wealth or making money. But because they have evolved, you have the ability to do that. And that's what banks have picked up on, you know? So we're talking about institutions that have some of the greatest minds in the world, right? We're talking about the best economists, attorneys, accountants, financial analysis, and other advisors. So they build this team of great minds to help them increase the efficiency and the use of their capital. All right, so the reason why they invest in cash value life insurances is because cash value life insurances provide banks with three major things: the ultimate safety on their money, stability, and growth. Okay, safety, stability, and growth. These are the three major things that cash value life insurances provide banks. Now, understanding this will help you understand that when they invest in these cash value life insurances, they put their money to grow for them at sometimes even up to a 15 to even a 20% interest rate, okay? And that interest rate will then be what? Compounded, all right? So that's where the growth potential comes in. Now they have the safety, where in the cash value life insurances, in most cases, you have a minimum floor. So that means that you can't get anything less than, let's just say, a 4% interest rate, right? So if those investments go south, you have the guaranteed minimum floor of not having to lose any money, okay? And then on top of that, you get to access that money tax-free. Okay, so it gives them the stability that they're looking for. Now, why not use that same concept for your own personal finances, right? So how many places do you know right now that can give you a maximum 15% rate of return, give you the safety, and at the same time tax-free? Okay, giving you the tax advantages, which, by the way, cash value life insurances are one of the most tax advantageous account series out there. Okay, so the real question is, would you rather leave your money in the bank earning less than 1%, or would you rather put your money where the banks put their money? Now that you know what you know, What would you rather do? Okay, so there you have it. Self-banking can give you money for a lifetime and not just for lunchtime. So if you're interested in learning more on how you can set this up for yourself and how you can become your own bank, okay, be on the lookout for a follow-up email with my calendar link to schedule a call with me or someone in my team to make sure that you get you on your way to becoming your self-bank. All right, until next time.